Ratio analysis. Ratio analysis is a financial ratio or accounting ratio. States that the relative magnitude of two selected numerical values taken from an enterprise's financial statements, often used in accounting. There are many standard ratios used to try to evaluate the overall financial condition of a corporation or other organization.
Liquidity. It finance that quick ratio, also known as asset test ratio, is a type of liquidity ratio, which measures the ability of company to use its near cash or quick asset to extinguish or retire its current liabilities immediately. Current ratio. The current ratio is a liquidity ratio that measures whether a firm has enough resources to meet its short-term obligation.
Current asset over current liabilities. The current asset of the company is 13,572,457,297 divided by 13,693,805,423 is equal to 1%.
Interpretation. This indicates that the company is able to meet their short-term obligation. Quick asset test ratio. The quick ratio measures a company's capacity to pay its current liabilities without needing to sell its inventory or obtain additional financing. The quick ratio is considered a more conservative measure than the current ratio, which includes all current assets as coverage for current liabilities.
Current asset minus inventory over current liabilities. The current asset is 13,572,457,297 minus 2,134,467,159 divided by 13,693,805,423 is equal to 0.75.
Interpretation. This indicates that the company has the capacity to pay its current liabilities without needing to sell its inventory or obtain additional financing.
Cash ratio. By adding company total reserve, the cash and near cash, adding that sum by the total current liability, that cash ratio is more than other liquidity ratios become the only consider a company must liquidate the resources. Cash ratio. Cash and cash equivalent current liability 24.21%, 13,693,805,424 equals 1.72. Interpretation. This indicates that a company has the ability to pay off short-term liability with a cash and cash equivalent.
Leverage. Leverage is any kind of financial ratio that indicates the level of debt incurred by a business entity against the several other accounts in its balance sheet, income statement, or cash flow statement.
Debt to asset ratio. The total debt to asset ratio is calculated by dividing a company's total amount of debt by the company's total amount of assets. Total liabilities over total assets is 16,064,564,079 divided by 33,746,006,847 is equal to 0.48. This indicates that the company has a total debt to total assets ratio of 40% of its assets financed by creditors and 60% financed by owners or the shareholders' equity. Activity, a type of financial matrix that indicates how efficiently a company is leveraging the assets on its balance sheet to generate a revenue and cash. Efficiency. This measures a company's ability to use its assets to generate income. Gross profit over net sales is 10,116,994,222 divided by 50,506,967,113 is equals to 0.20. This shows that the company retains 20% of revenues generated and 80% is attributed to incurred cost of goods sold. Return on asset ratio. The return on assets shows the percentage of how profitable a company's assets are in generating revenues. Net income over total sales is 3,212,535,993 divided by 33,746,006,847 is equal to 0.10. This indicates that the company efficiently uses its assets to generate profit. Return on equity ratio is the measure of a company's net income divided by its shareholders' equity. Net income over shareholders' equity is equal to 3,212,535,993 divided by 17,881,442,768, which is equals to 0.18. This indicates that the company efficiently uses its equity to generate profit. Efficiency. This measures a company's ability to use its assets to generate income.
In accounting, the inventory turnover is a measure of the number of times inventory is sold or used in a time period, such as a year. It is calculated to see if a business has a excessive inventory in comparison to its sales level.
Cost of goods sold over average inventory 43,254,730,460 divided by 2,134,467,159 is equal to 20.26. This shows that the company is selling its goods or service quickly because there is high demand for its product in market. Solvency. A ratio is a key metric used to measure an enterprise's ability to meet its long-term debt obligation and used often by prospective business lenders. Debt to equity ratio. This shows how much debt a company has compared to its asset. It is found by dividing a company's total debt by total shareholders' equity. A higher debt to equity ratio means a company may have a harder time recovering its liabilities. Total liabilities over shareholders' equity 16,064,564,079 divided by 17,681,442,768 is 0.91. This indicates that the company is borrowing more capital from the market to fund its operations.